learned from the lesson. Live in the hills, but it still get a spread. Started with a live, but it still reinvest it. Fear how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but the sound like progression. Farmer never plans if he waits for perfection. Fingers to the down, hold on.
All right, week 2, trying to get Peter Schiff on my podcast. I thought I'd show him my watercolor. Oh, is that a piece of gold? Another one. Anyways, I must have forgot my silver bar there. But Peter, we'd love to talk to you, bro. We got water. We don't like Bitcoin. I do. Well, we'll talk about it, but okay.
All right, no, I'm just playing with you guys. Hopefully you had a wonderful weekend or having one. I was going to make a different weekend video, but then 2 things happened. Literally, Biden had a speech. It was very important. Some people were even saying it's probably going to be his most important speech. And then there was just a bunch of articles on bonds. If you don't remember this video, we were talking about the market not pricing it in. Well, Chad, Wall Street is picking up on it. So I want to go over the bond divergence, and we're going to talk about actually 2 things. I promise you, you will learn something. I'm going to make it quick. I'm even going to go over the play that I made on Friday. We're going to talk about it on Monday, but I did add to another one of these global plays. I got a call on Turkey, but we'll talk about that. And then we are going to talk about here with oil. And now let's talk about the title here. Is oil going to 150? If everything plays out like we've talked about in these last couple of videos, and you watched Europe crack, as Biden would say, in the next 30 to 40 days, or even a little bit longer, then yes, I think it's going to get crazy. And even then, with some of what I'm about to show you here right now, at the very least, this short term is not looking good for oil. So if anything happens with like Saudi Arabia and Yemen, and you saw that effect there on Friday bringing up oil, but if anything with this deal starts to play out, it is going to be bad. But pretty much here's the thesis really I'll give you. I mean, we're going to talk about this right here, and this is oil inventories, and this is what's key. This is every European country, and you could see, like Finland and Denmark, they got like almost a full year of inventory, but as you see here towards the bottom, the UK, they are kind of actually in the lowest, and they're now below, I think, 30 or 40 days there of diesel. So this keeps coming out. These headlines, people are saying global diesel supplies are hitting a worrying level or worrying low, but this is the point of it. But now what we got with Biden today, his speech, the thing that was so controversial, he has never said this whole time. He said that Putin can no longer be in power. That's a very, very big claim. But now on Friday, you had an energy deal with us sending gas to Europe, and pretty much Biden is doubling down on this strategy. So what does that mean? Our reserves are going to go lower. Global reserves are already lower, and it's probably going to contribute in the short term to more pressure on oil. So that's what I'm looking at. But now take a look at this quote. This is going to be the key here in the short and the midterm. Those stockpiles aren't evenly distributed though, and stresses will emerge sooner in some locations than others, while Finland and Denmark hold in private and government controlled inventories to keep running for more than 6 months. The UK and Norway have little more than 30 days. So I already told you this, but the whole key now is going to be shuffling diesel and natural gas supplies from all of these different places, and that's what we're going to see. So shipping and other stuff will come into play with it, but now we also got talks of an SPR release on Friday. Essentially, if we see any more short-term escalation at the same time you get these easing methods, it's going to play out a little bit weird. But now take a look at the oil chart here. You remember the Omicron pattern? We were talking about this after the first drop. It's going to drop, come back up a little bit, chill out, and then continue the resumption. Well, essentially, Biden said a lot over here on the weekend. We'll see how people take it, or again, in this next 30 to 40 days, you got a little bit of time. But the idea here now is watch. Does this week turn into the week where it kind of starts to slip down a little bit, or if we do get more escalation, it starts to take off? But that is the first part. Now let us get to the bonds and the bond divergence. I love this one. So you remember video 4 days ago, I'm saying this isn't priced in. You've seen this chart right here. What is it showing you? Bonds and S&P, there's a big divergence. And now what has even happened since the rate hike? Bond rates are hitting a historic level. You haven't seen the bonds get sold off like this since 2008. And the other time you've ever seen anything like that, it was like 1970. So it's absolutely wild. But now we're saying this isn't priced in. You're watching stocks bounce up while bonds keep going lower. People are saying, well, maybe the market's already priced in and ready for it and we could handle it. Well, it seemed like nobody was talking about it, but now this is why I need to share with you over the weekend here. Everybody is starting to talk about it now. I thought it was funny it came out over the weekend, but you can see it. Stocks defying bond market danger put Wall Street on notice. Risk asset rallies even though treasuries are signaling bad news. Here's another one. Surging stock market turns a blind eye to the Fed at their own risk. Equity buoyancy gives the central bank cover to turn more hawkish, and that's what we've seen. The Fed and Fed futures are getting more and more hawkish, more than we've ever seen. But now this little bounce here, it's allowing people to kind of look at other things, and now we are getting this push and pull. But you see people talking about it. Here is the development. I just got two things. One, the rebalancing of like sovereign funds and pensions, that was playing into it. But now two, it seems like 2.75 on the 10-year. That is probably going to be our level. Right now we are at 2.5, so pretty much like another quarter point from here. This is where people are expecting to get kind of messed up. But here's the first factor, and you can see it was written about it. They're saying that technical factors have been playing a role in why the divergence has been occurring. They're saying, according to JP Morgan, strategists, pensions, and sovereign wealth funds, they have already deployed as much as $230 billion to stocks to meet their allocation targets. And now that the move is played out, strategist Nikolai Panigru, I can't say it, he says equities look vulnerable. And then here's another one now, and you can see how they mix in both of it. They're saying the rebalancing flows away from bonds into equities likely supported equities and hurt bonds over the past 2 weeks. Now that there's no much of pending rebalancing flow, equities would look more vulnerable from here if bond yields continue to rise. And then you got another person, this isn't the other guy, this is now Peter Chatwell. He was saying it's only a matter of time before the rate-sensitive investing styles reprice, and that's what we're saying. None of this is priced in. He says we think the 2.75% rate will be highly restricted for the U.S. and equally important for the global economy, Chatwell said, referring to the Fed's projection of the benchmark in late 2023. Slowly but surely, risk premia will rise and earnings expectations should moderate. Again, earnings will be key to this, and he's talking about the Fed funds for 2023 getting there. I think it's going to be pretty much the 10-year, 2.75 to 3%. We may start freaking out there, but now it's been a couple of weeks. It seems like the market's ignored it. That's what we're going to be watching coming into this week. And now Biden doubling down on natural gas strategies and sending reserves everywhere to combat this. We need to watch for escalation, but these are two big things. Hopefully it ties into some of the other theories, and hopefully you're ready. And I guess that's pretty much it. I'll tell you the last play here. I did this on Friday. I went for Turkey calls. Yeah, TUR. This one's a little bit weird, but here's my logic behind it. Turkey is actually a NATO member, but they're like in a weird space. It's like they're a weird NATO ally more or less, but this is what makes it so interesting. They are one of the friendly nations of Russia still. So Russia's been clapping a lot of people, but they still like Turkey there. So I thought they may be able to benefit off of it. We've talked about winners and losers, but this one, I don't know if I'm as confident. I got a Turkey, where was it? August, $22 call. Grabbed 5 of them for about 90 cents, just under $500. So we'll see. I do like the EWG and the VGK a lot better. So we'll see. And don't forget about commodities and wheat, bro. Don't forget about that. Those are still in play. We still got all those, but we'll see how this plays out. I'm going to give you the watch list tomorrow. We're going to talk about a lot, but definitely now with these things in play, this will be important for the week. So Chad, I love you guys. I hope you had a wonderful weekend. I will see you very soon. Couple of, I don't wear a watch, but a couple of hours, we're going to need. So enjoy the weekend. Stay peaceful. Control what you can control. You know what I'm saying? And I love you, baby. Let's go, baby. I don't know how to end these.